Hello everyone, welcome to my channel. Today I'm going to talk about what you need to know about health saving accounts. Before I get into the video, be sure to subscribe and leave a comment below saying I subscribed. We will try to personally reply to your comments. Let's get into the video. The health saving account HSA is one of the most misunderstood and underused benefits in the Internal Revenue Code. Congress created HSA as a way for individuals with high deductible health plans to save for medical expenses that are not covered by insurance due to high deductible provisions of their insurance coverage. HSA as a retirement vehicle. Although the tax code refers to these plans as health saving accounts, an HSA can act as more than just a vehicle to pay medical expenses. It can also serve as a retirement account for some taxpayers who have maxed out their retirement plan options. An HSA provides another resource for retirement savings, one that isn't limited by income restrictions in the way that IRA contributions are. Since there is no requirement that the funds be used to pay medical expenses, a taxpayer can pay medical expenses with other funds, allowing the HSA to grow through account earnings and further tax-deductible contributions until retirement. In addition, should the need arise, the taxpayer can still take tax-free distributions from the HSA to pay medical expenses. Unlike traditional IRA, no minimum distributions are required from HSAs at a specific age. Withdrawals from an HSA that ain't used for medical expenses are taxable and subject to a 20% penalty, with one exception. An individual aged 65 or older will pay income tax on non-medical related distributions from the HSA but won't owe a penalty for using the funds for other than medical expenses. Let's look at an example. Let's say Henry, who is age 70, has an HSA account from which he withdraws $10,000 during the year. He also has unreimbursed medical expenses of $4,000 of his $10,000 withdrawal. $6,000, that is $10,000 minus $4,000, is added to Henry's income for the year, and the other $4,000 is both tax and penalty free. If Henry had been 64 years old or younger, he would be taxed on the $6,000 and pay a penalty of $1,200, 20% of the $6,000. Eligible individual. To be eligible for an HSA in a given month, an individual must be covered under an HDHP on the first day of the month, must not also be covered by any other health plan, although there are some exceptions, must not be entitled to Medicare benefits, that is, generally must be younger than age 65, and must not be claimed as a dependent on someone else's tax return. Any eligible individual, whether employed, unemployed, or self-employed, can contribute to an HSA. Unlike with an IRA, there is no requirement that the individual have compensation, and there are no phase-out rules for high-income taxpayers. If an HSA is established by an employer, then the employee and or employer can contribute. Not just family members, but any other person can make contribution to HSAs on behalf of eligible individuals. Both employer contributions and employee contributions made via the employer's cafeteria plan are excluded from the employee's gross income. Employees who make HSA contributions outside of the employer's arrangements are eligible to take above the line deduction. That is, they do not need to itemize deduction for those contributions. Maximum contribution amounts for an HSA. The amount can be contributed are determined on a monthly basis and are calculated by dividing the annual amounts by 12. Thus, if an individual health plan only qualify that person for an HSA for 6 months out of the year, then that person contribution amount would be half of the amount. The maximum annual contribution year 2020, self only 4550, family 7100. For 2021, self only 3600, family 7200. In addition to the amounts, an eligible individual who is age 55 or older can contribute an additional 1000 per year. How HSA are established. An eligible individual can establish one or more HSAs via a qualified HSA trustee or custodian, an insurance company, bank, or similar financial institution in much the same way that an individual would establish an IRA. No permission or authorization from the IRS is required. The individual also is not required to have earned income. If employed, an eligible individual can establish an HSA with or without the employer's involvement. Joint SSAs between a husband and wife are not allowed. However, each spouse must have a separate HSA and only if eligible. Qualified medical expenses. To be non-taxable and penalty-free, distributions must be for unreimbursed expenses paid by the HSA account owner, the spouse, or dependents for medical expenses that have the same definition as minimum medical expenses for purpose of medical itemized deduction. Amongst paid for medical or drugs are qualified medical expenses for HSA distribution purposes only if the medicine or drug is prescribed, determined without regard to whether such a drug is available without a prescription or insulin. The qualified medical expenses must be incurred only after the HSA has been established, and medical expenses paid or reimbursed by the HSA distributions cannot also be claimed as medical expenses for itemized deduction purposes. Generally, health insurance premiums are not qualified medical expenses for HSA purposes, except for the following. Qualified long-term care insurance, but only up to the amount of the annual age-based limit that applies for deducting long-term care premium as medical expenses. COBRA healthcare continuation coverage. Also, healthcare coverage while receiving unemployment compensation. And for individuals aged 65 or over, premiums for Medicare A, B, or D, Medicare HMO, and the employee share of the premiums for employer-sponsored health insurance, including premiums for employer-sponsored retiree health insurance, but not Medicap policies. Thanks for watching this video. Please do not forget to subscribe to my channel. Also, click on the link below in the description of the video to download my free ebook on the 5 legal tax loopholes for tax saving strategies for individuals and business owners.